Hello and a very warm welcome to Bruegel's event. My name is Guntram Wolf and I'm very pleased to host today Jayla Pazabazioglu from the IMF. She is Director for Strategy, Policy and Review in one of the core departments in the core department of the IMF. And has written extensively on a variety of topics, including more recently, of course, on the risk of geopolitically driven economic fragmentation. But prior to that, the reason why we have this event, she has worked together with her team on a wonderful work stream on how to deal with debt, and in particular private sector debt after the pandemic. We all know that during the pandemic, the public debt in the private debt in the corporate sector has increased quite substantially because many companies were forced to reduce their sales, reduce their activities massively, while some of their costs were still, continuing to be high, and they could borrow at preferential rates, ensure that the shock was not immediately leading to bankruptcy. But now they are basically still sitting on a lot of corporate debt, and so the question is, how do we deal with this corporate debt? And I think this is a very interesting question because it determines also whether or not and how these companies can grow out of the debt, and whether they can invest, and therefore also our economies can grow and invest out of this very severe recession that the COVID pandemic meant to the global economy. And so Jayla, without much further ado, perhaps you can give us a bit of a rundown on what you think is critical, and why is this topic so critical for the recovery, and what are the main proposals? And we're going to have a sort of conversation on this topic. I do want to ask you also about the geopolitically driven fragmentation, but perhaps more towards the end. And of course, I do want to encourage you, our dear audience, virtual audience, to ask questions. And for that, please go on Slido and type a code which is available on our website, and I guess the code is okay. I don't see the code now, but I'll give you the code in a second. But I'm sure you firms. Is it firms? Okay, the code is firms. So please put on here we see it, slido.com. You type in firms, and then you can ask a question. Jayla, please, the floor is yours. Thank you.
Thank you, Guntram. Great to see you, and thank you to Bruegel for this very timely and important discussion. It's a great pleasure to be with all of you there, as well as, of course, those joining online. So as you mentioned, we have been looking at the impact of COVID-19 on private debt. What has been the implication? What does this mean for growth for member countries? And also what needs to be done to address this issue? To just put it in context, most companies entered the COVID-19 crisis with elevated debt levels already on their balance sheets. This, of course, partly reflected the result of the global financial crisis, and after that, very low interest rates and relatively easy financial conditions. So private debt increased to 143% of global GDP by end 2019. Corporate debt was 90% of GDP at that time, 90% of global GDP at that time. Governments, of course, provided a lot of stimulus to deal with the effect of COVID-19. Those that had fiscal and monetary space were able to provide more stimulus. And this took the form of, for both consumers and corporates, credit guarantees, concessional lending, as well as moratoriums on interest payments. So what we saw was a very large surge in borrowing by businesses and households. We actually have the April 2022 World Economic Outlook, excellent analysis, must read if you haven't done so already. Private sector debt and the global recovery is what it's called. It's chapter 2 of the April 2022 WEO. So that shows that global public debt and global private debt increased to 83 trillion in 2020 by the end of 2020. That's 13 percentage points increase. 156% of global GDP. So we're talking about large numbers, close to 100% of global GDP for corporate debt. A lot of that increase was advanced economies and China. 90% of this 8.9 trillion increase in 2020 was actually mainly advanced economies and China. And that, of course, has implications given what we are going through now. The non-financial corporations had very large debt ratios, especially in the context of advanced economies. And what that meant is that firms with already elevated debt levels and vulnerable firms, those that are in the high contact intensive services sectors, often borrowed quite a lot to survive the COVID-19 crisis and are now at record levels. So what does that mean for the global economy is that this is really going to be critical for shaping the recovery ahead. Central banks are raising interest rates to deal with inflation and to deal with making sure that the inflationary expectations are not de-anchored. That means firms' debt servicing costs will increase. Corporate vulnerabilities will also increase as governments pull back the stimulus packages, they scale them back. They had huge amounts during the pandemic, and this will be much more targeted going forward. And of course, we have the slowdown in China, which has implications, especially for emerging markets and developing economies, because China has been the largest creditor for many of them. So if you put all this together, we do have very difficult conditions ahead, which makes it very important that we use all the tools to be able to deal with these conditions. So we can talk about what are the tools and how different countries have the tools, but it would be good to hear from you as to what you think are the vulnerabilities in the corporate sector, what you see from where you sit, and do you agree with our analysis so far?
Yes, wonderful. Thank you. So I basically wanted to ask you how worried you are really. I mean, and I think the question you're asking me is exactly that. I mean, I think it's clear that the COVID pandemic has been a huge shock. But when I look at corporate insolvencies, for example, and I think the last update I did was a few months ago, but I saw very little, right? So, and when I look at bank balance sheets, I also didn't see a lot of sort of bad loans emerging, and so I guess the question is at the current juncture, yes, corporate debt has gone up, and also and of course also government debt has gone up a lot. But yes, financial conditions have been also extraordinarily accommodative, and rates have been very low. And these low rates meant that you add another 50% of your sales to your balance sheet in terms of debt. But if the debt is almost cost-free, I mean, then it's not a big issue. So I guess the key question to my mind is really what kind of financial tightening cycle are we seeing? And of course, in the US, the financial tightening cycle is already more advanced than in Europe. In Europe, it's certainly not yet at the US level. We see some financial tightening. We see some increase in spreads. And also the ECB, I think, will in its June or July meetings raise rates. But I think the tendency will be to be relatively cautious in raising rates, and so it will take quite some time until financial conditions really become so tight that then the corporate sector really feels it. I mean, of course, a lot is bank borrowing, and typically in the European corporate sector. So they borrow from banks, and so their the funding conditions can relatively quickly also change on the entirety of the debt. But I mean, I guess all I'm saying is, so far, this additional debt during the pandemic doesn't yet seem to be a major cause for a cause of worry. But of course, a rapid financial tightening could raise some issues. I mean, that would be my broad answer here. I don't know if you agree on that.
Yeah, I agree. I mean, it is surprising that we see so little insolvencies and bankruptcies. If you had asked any of us 5 years ago, we would have this major pandemic, what would happen to corporate sector, we would have expected much more increase in insolvencies and bankruptcies. And I think part of the reason, of course, is the stimulus packages, but part of it is also a lot of regulatory forbearance by many countries. So there was a loosening of regulatory standards that could create potentially less transparency in bank balance sheets in terms of non-performing loans. So I think it will be very important to not be late in diagnostics. That was the big mistake in the global financial crisis. The diagnostics came very late in the game. That makes it very difficult then to adapt one's strategy accordingly. So it's going to be very important to do, and we have the tools now. We use them in the global financial crisis. We can use them again, asset quality reviews, stress tests, making sure that the banks take into account different scenarios that can unfold going forward to really see where there are pressure points and what needs to be done. There are also, I wanted to talk about also another report I would like to advertise that we published in February. It was basically about supporting and restructuring firms in the aftermath of the COVID-19 pandemic. It's very good analysis. It also provides a novel indicator of crisis preparedness. It measures the extent to which countries' insolvency and restructuring regimes are prepared to handle large-scale corporate insolvencies. It covers about 60 economies that account for 91% of world GDP and 84% of the global population across continents and levels of development. So it includes advanced economies, emerging markets, and low-income countries. There are 5 dimensions that the indicator looks at and assesses countries relative to each other. And those 5 dimensions are informal mechanisms for out-of-court restructuring between debtors and creditors, hybrid restructuring, reorganization, liquidation, and the institutional framework insolvency, like specialized judges and digital courts and so on and so forth. So that shows that, low-income countries are least prepared for a corporate debt crisis. But you see that in many emerging markets and advanced economies, they can actually do more as well. So I think in this report, we show that about 40% of advanced economies with vulnerable corporate debt in sectors that are vulnerable or in companies that are highly leveraged have below average crisis insolvency systems that could really struggle in the event of a large number of restructuring. So I think it's going to be very important to determine what can be done in the medium term, what can be done in the short run, what can be done in the medium term to do the necessary reforms in order to deal with, in order to improve the insolvency systems in many countries.
Well, I mean, you mentioned the insolvency systems, but let me perhaps ask you a bit more of a provocative question to get your reaction on sort of this question of corporate restructuring and recessions as an opportunity to sort of reallocate resources in an economy from old and dying industry towards the new and growing companies. And of course, I mean, this goes under the heading of creative destruction. But I have to say, I didn't like that term very much during the pandemic, because of course during the pandemic it wasn't at all creative. It was basically health policy driven constraints on companies that meant some companies were doing well, while a lot of companies were doing badly. So, and this was really not because of their degree of innovativeness or newness or growth potential, but really just a reflection of the fact that they were more or less directly exposed to the virus and the government health policies to contain the virus. So in that sense, I don't think the right moment, the pandemic was the right moment to let creative destruction play out and do its role. On the contrary, it was totally appropriate in that situation to support firms and compensate them for the loss coming from the health public policies. Now, having said that, now we are in year, I guess year 3 of the pandemic. And let me remind our listeners, the pandemic isn't over. It's still with us. The virus is still with us. There can still be new viruses and new variants coming, etc. So let's not be complacent on that front. But anyway, we are in year 3, and at some stage, of course, there is a question. What kind of restructuring regime is the most suitable, so that there is this creative destruction and this new economy emerging from the ashes of the old, to provoke a bit your reactions. This a bit provocative term, ashes, because of course it hasn't been a full fire burning. But anyway, I mean, so I guess. How do you think about this issue? Sort of, at what stage would it even be helpful to see some restructuring and some changes in the composition of firm structures?
Yeah, I think that's a very important point, and I agree fully that not only we had the pandemic and the implications of the pandemic, but the pandemic also accelerated the digital transformation. So you see much more use of digital technologies by companies, by also the financial sector, and so on. So we do see a big change, and we will, of course, not only we have to now deal with the pandemic, but unfortunately we live in these surreal times of a war in the middle of Europe, which also has implications in terms of something that we will discuss a little later, in terms of countries and companies wanting to strengthen the supply chain resilience. So there's a lot of many factors that are impacting the corporate sector and how they are functioning now and how they will function going forward. So I think it's going to be very important, as you said, to allow firms that are viable to be able to deal with their liquidity problems, if that's the issue, or to deal with this highly leveraged situation they're in, by restructuring, by both financial restructuring and operational restructuring, to be able to survive and thrive in these changing circumstances. So what that means is, again, diagnostics. And here I find an interesting issue, or something that we haven't dealt with before, is that when you need to do corporate restructuring, you have investment banks, you have the financial sector, which has, as you said, in regions like Europe or in most of the emerging market countries, where you see the banking system as the main provider of credit to companies, and they are usually leads in terms of the restructuring. Of course, the government provides the mechanisms, the infrastructure, but there is a lot of restructuring that is done through the banking system. So the financial sector authorities, government, working together with the banking system, usually deals with these large-scale corporate insolvencies in that manner. But now with a lot of this not very clear in bank balance sheets as to which companies are really struggling, and also increase in digital finance and supply chain finance by companies, it becomes more challenging to do the restructuring because, central banks or regulatory authorities can work through the banks to understand what the problems are in the corporate sector, how large scale those problems are, and use the different tools that they have, as I mentioned, out of court settlement systems. If you remember, there was the London Club approach, Thailand did Bangkok approach, in Turkey we did Istanbul approach. So there are different ways of setting principles to get the corporate sector restructuring at a larger scale. But that only works one, if you understand the scale of the problem and you can identify which are the firms that really need to be liquidated, which are the firms that are having, some insolvency issues, but can actually survive after restructuring, and which are the firms which are fine, they just have liquidity constraints in the short term, and with liquidity support, they can actually manage through the crisis. To make that triage is difficult, and it requires advanced action. Again, the regulatory authorities working with the banking system to assess what needs to be done and put the necessary instruments in place. When you have a lot of the financing done through non-bank financial institutions, digital finance, or through the supply chains, then it becomes much more difficult for the authorities to be able to work to provide the conditions for the system to work out its problems. So that's something that we will have to think through going forward, especially as digital finance gets much more prevalent.
Yeah, wonderful. So I do want to push you on a bit this triage and fiscal point and add my thoughts on that. But before I do that, let me remind our audience that you are welcome to ask questions on Slido. Type in the code FIRMS, and then please come up with a question that I can ask to Jaila. So please do so. I mean, the question I wanted to push you on and ask you on is really about the triage and the fiscal dimension of this recovery. I mean, as you say, some firms face liquidity constraints that are temporary. Others might face more long-lasting constraints, and those, of course, eventually will have to be restructured. And so the art of triage, both on the side of the financiers, but also at some level at the level of the government that provides fiscal support programs, is really essential. And so I guess my question is really how much of a view do governments need to take about the future shape of our economy in order to take their decisions on triage, on restructuring frameworks, etc. I mean, let me just give you one example. I mean, so one interesting example is the transport sector. I mean, when we look at the number of trips that is being undertaken, we see that in year 3 of the pandemic, even though there has been a recovery of international and national daily trips, we are still well below the level of pre-pandemic. At what stage do governments actually think that this is the new normal, right? I mean, the average number, I think there were some nice numbers in the Financial Times a few days ago when the Elizabeth line in London was opened. They showed the numbers that the daily trips in the UK are still at a much lower level than they used to be, and of course that determines, if you think that's the new normal because people will work 2 days a week from home. I mean, then you need different kinds of investments and you need different numbers of firms. in the transport sector, etc., etc. And I mean, this is one example, the transport sector. The other big example is, of course, the greening of our economy. I mean, the government has a clear vision about the decarbonization of our economy and the speed with which we want to decarbonize our economy. Well, is this the moment now to accelerate some of the decarbonization and support carbon-rich companies less or not? I mean, so these are just two examples where visions about the future shape of the economy, of course, shape restructuring policies and support policies towards firms. And this raises lots of trade-offs and lots of questions. And so I would love to hear your thinking on that.
Yeah, I think this is, of course, the biggest challenge that governments will have to face. And there are some basic principles for designing public support schemes, right? So setting very clear objectives as to what market failures are meant to be addressed, with depending on the fiscal space as the main constraint. Making government subsidies, be it in renewable sector or other areas, conditional on debt resolution and burden sharing across lenders and borrowers. A third one is involving relevant ministries and agencies in designing the implementation and ensuring the enforcement. And the last but not least is to put in place strong safeguards to address moral hazard and adverse selection. So the design of the public intervention has to be transparent, mitigate risks to financial stability, because at the end of the day, it needs to be very clear who is taking the risk. Is it a government guarantee? Is it the financial sector? Is it the borrower? And of course, focusing on the most distressed firms, as well as making sure that there's a time-bound strategy. So I think those are clear basic principles that governments need to follow. But I think at the outset, the key is going to be, what are a clear set of objectives as to what are the market failures that are being addressed. What is it that the market cannot do on its own? So I think that's where we need to, of course, public goods like climate and so on, it's very clear. But in some cases, we have seen, unfortunately, in many countries, emerging market countries, but also advanced economies, where poorly targeted support schemes actually ended up with zombification, what you were saying earlier, keeping firms that should exit alive and creating all sorts of drag on growth and entrepreneurial instincts and innovation.
So we have one question by the audience that I think you partially already answered, but I do want to read it to you, and perhaps there's some aspects you haven't reacted to yet and can still add. So the question is, how can governments, many of whom have tight fiscal space, design effective public support schemes for troubled firms, and what principles guide IMF advice? So I think the last one and the tight fiscal space are perhaps new dimensions that you might want to react to.
Yeah, it's a very good question. I think this is a key challenge. Many countries do have limited fiscal space, which makes it much more difficult. And in terms of principles, I mentioned them, but especially when the fiscal space is limited, it's going to be very important to do the diagnostics, right? Again, this comes back to the question of the triage and making sure that this is done properly to support firms that need support, but that are going to be profitable and be able to provide tax revenues going forward, and make sure that the firms that are not profitable, not viable, are do exit. Of course, that has implications to the extent that there are some state-owned enterprises or others that have large, labor that will be impacted. There will, of course, be public pressure. So it needs to be carefully communicated as well. But I also want to mention that not all debtors and creditors are alike. Non-financial corporations and households that borrow money are typically constrained financially, but not to the same extent. So high net worth liquid households and firms face very different constraints compared to low net worth, illiquid, and households and firms. And the level of support to these different groups is going to be very important in terms of determining inequality, widening inequality. So with this large level of indebtedness and already existing inequality, I think a key principle also has to be that these restructuring efforts and support schemes are designed in a way to not exacerbate further the inequalities that exist within and between countries.
Yeah, thank you. And I think it's very important that you insist so much on principles, right? I mean, there's always a temptation, I guess, in the political system to go after fashionable trends or short-term political priorities or even capture. And I think that it's quite important to avoid that. And focus on good design of these processes. And so I have one more question here that I do want to ask you, and then I want to ask you afterwards about geoeconomic fragmentation. But I mean, the one question we still have here from the audience is about how realistic it is, in your opinion, to switch to more solvency-focused government support as opposed to liquidity support on a large scale. I mean, how realistic is that?
Yes, I mean, that's the challenge, isn't it? So large-scale liquidity support is relatively easier. It's blanket. You can provide it across the board. The principles can be set very clearly and so on. But again, it goes, how realistic is it? Well, I mean, it has to be done. Otherwise, we will end up with zombification. And we have lessons from Japan, which then changed its approach and has been able to generate a much better functioning system. There are other countries which have done it. So I think it's very important not to keep providing liquidity support when the problem is insolvency. And of course, the challenge is, how do you determine liquidity versus solvency? It's a continuum, it's a gray zone in between. When you are hit by shock after shock and the T+1 or T+2 is difficult to see, what are the with different trends in terms of the public goods aspects that we are trying to address, the climate change, the move to digitalization, dealing with inequality. All these have, of course, implications in addition to the pandemic and so on, to what are the structural changes in the way the economies are functioning and how the corporate sector will function going forward. So I think it's very difficult, given all these challenges and the supply chain related issues, to determine, is this really a liquidity problem or a solvency problem? But I think it is important to, and again, I go back to the triage again, because if you don't have the diagnostics, you can't come up with a good strategy. So the sooner one can start that, and it could be in the context of stress tests, working with the financial institutions and so on, to really determine when to move from broad-based liquidity support to much more targeted liquidity and when needed restructuring or solvency support.
So we did get one more question, which is by Fiona Bowery, and it is about, I think I would rephrase that question perhaps and say it is really about international comparability. How do you have a methodology that assesses vulnerability of firms between different countries and makes sure that the mechanisms applied for support, etc., are comparable? the more two countries are economically integrated, the more, of course, the comparability of the support mechanisms becomes important to ensure a level playing field and avoid sort of market distortions. I mean, we have WTO mechanisms for that, but give us a sense from a more methodological IMF point of view. How would you go about, and how do you go about in terms of methodology to really compare productivity levels of firms, etc., across different countries to have it comparable, really? I mean.
Yeah, I mean, it's difficult because conditions are very different, but I think, vulnerabilities, one can look, there are some indicators, and one does look at corporate sector leverage, which has increased very sharply during this crisis and has, of course, implications. You can look at the sectors that the different firms are in, the transmission mechanisms in terms of their balance sheet exposures, assets and liability, FX mismatches or asset duration mismatches, maturity mismatches. So there are indicators which determine the vulnerabilities in the corporate sector, which, as I mentioned, is in the report that we published. But then it's very important, I think, to look country-specific vulnerabilities in the corporate sector and what that means in terms of crisis preparedness and the tools that can be used by countries. And that's the second part of it. The first part of it, vulnerabilities, what they are within for each country, how they compare across countries, as the question came, and then the different types of instruments to deal with restructuring and how that compares across countries. With cross-border flows and cross-border financial flows, where certain financial institutions are very present in other countries, that also becomes an important issue to coordinate regionally or globally. If you remember, during the euro area crisis, the Vienna initiative was put together to deal with a large-scale corporate and financial sector issues, vulnerabilities, solvency problems, liquidity problems that came up during that crisis. And that was a very much of a coordinated way to deal with problems across several countries.
Okay, so let's spend perhaps the last few minutes talking about geoeconomic fragmentation and I mean, pushing you a bit, of course, on the more recent developments in the current situation with the war in Ukraine and of course the tensions between China and the US and others. You have just published a blog post together with the managing director and the first deputy managing director, Gita Gopinath, on exactly this question of geoeconomic fragmentation. So a fragmentation of a global trading and financial system, which the IMF is underwriting, but also the WTO is underwriting, and many other multilateral institutions are really supporting. And I guess this is on many dimensions now under attack. I mean, there's issues such as purely geopolitically driven risks. There's risks that result from differential policy implementation, perhaps in the climate area. I mean, there's a multitude of sort of risks to these global integration of our value chains, and an important base of our global wealth. So what do we do about this, and how do you think as a multilateral institution about it? It's all national politics again. How do we deal with it?
Yeah, this is a key concern for us. A more fragmented world would, of course, be poorer and more dangerous from a political perspective. We are a multilateral institution. We would like to stay that way. And I think overall, this has served the world well. Of course, there are issues with globalization in terms of unequal advances by countries, those that are left behind. You see this in many countries, advanced economies. In US, we see this very clearly. So the widening inequalities and this dissatisfaction with globalization. But if you step back and look at a careful analysis, it actually has served the world well in many aspects, and it's going to be very costly to fragment the world. We have to separate or differentiate rather the necessary strengthening of value chains and value chain resilience, supply chain resilience. So that I think is important. Diversification is good, but that doesn't mean reshoring or fragmenting the world. It just means that we need to have some insurance and some resilience in supply chains, which will have implications in terms of fragmentation, but that can be done in a quote unquote smart way to make sure that the countries have the safety and the resilience they need, but at the same time, we don't throw the baby with the bathwater and go to an opposite extreme of really fragmenting the economies and the world. So I think we have to be very careful, especially at the time, and you mentioned this, especially at the time, you need multilateralism, you need global coordination to deal with the public, the public goods aspect of huge challenges that we are facing: climate change, digitalization. How are we going to deal with the challenges and make sure that we use the opportunities and deal with the risks if the world is going to go into different poles, multiple different arrangements and fragmentation. So I think it's going to be extremely important to coordinate as much as possible. So I think we have some analysis which shows that technological fragmentation alone can lead to losses of up to 5% of GDP for most countries. And that's a really substantial amount. For households, those at the lower income levels would be hurt, costs would increase. This ranges from middle income factory workers who export to low paid workers who depend on food imports to survive, to high paid professionals who will not maybe have the opportunity to work in other countries. So I think it's going to be very important to think about both for households and corporates that who have benefited from an integrated economy, that we make sure as much as possible that we deal with some of the lessons we learned through the pandemic, but at the same time really try to make sure that the global coordination remains at important levels. We were able to fight the global financial crisis because the international community came together. I remember at the time, this was mainly at the G20 level, but also with many other countries, that there was a lot of coordination that led to joint initiatives and be able to deal with crises. So I think it's going to be very important to keep areas of mutual interest, work with them together, and we identified them in the blog, like making sure that the reconfiguration of supply chains and barriers, that this doesn't lead to barriers to trade. We still keep rule-based trade, free flow of capital and services. That was one key area. Debt restructuring, which is going to become much more complicated in a world which is much more fragmented. Global financial safety net, again, critical given that we face shock after shock. So it's going to be very important to make sure that we find ways to work together to be able to deal in an effective way with the multiple challenges that we face as the global community.
Yes, a very important plea, I think, to governments to not forget about the importance of cooperation globally. But of course, since we are talking here today about firms, perhaps the last word and the last question is on firms. I mean, what kind of advice can you give to big multinational firms or even smaller multinational firms that operate in many, many different jurisdictions and are directly exposed to these major geopolitical tensions? I mean, certainly the advice cannot be just continue as before and run supply chains that are just in time and without any margins, without any robustness. So my view here is governments need to also communicate that they cannot bail out every disruption coming from geopolitical shocks, and that firms do have some responsibility in making their supply chains resilient and diversifying away from concentrated risks, right? It seems to me this diversification argument is actually, and the stockage of critical supplies moving away from just-in-time production are two key elements of a response at the firm level to geopolitical risks. The result, of course, thereof is that costs will increase, at least in the short term, and so that then has macro implications. So it's a very difficult situation actually for policymakers to advise on. But I don't think we can advise as policy, or we can advise firm leaders to just ignore geopolitical risk and hope for global cooperation. Do you agree with that?
I fully agree with that. I think firms will need to also assess, and I think they have been doing so. We have been meeting with firms and discussing with them exactly what you said, having more resilient and more diversified supply chains. But more diversified is the key word. That doesn't mean you diversify, you basically stay to your home base. That's not diversification at all. That really exposes one to much more risks. So diversification in the broader sense, again, identifying what the bottlenecks are and addressing them. And in some sense, Guntram, it's not so different from the global financial crisis, right? At that time too, the international community came together and there were costs on banks, right? The TLAC was introduced, and I remember at the time a lot of pushback from the financial sector. This is the total loss absorption capacity of the financial institutions, especially global systemically important banks. It's the same idea that you really need to have mechanisms in place, the right amount of capital, the right quality of capital in place for the banking system to weather crisis. And I think what happened in the global financial crisis and the measures taken after that to make the system more diversified, more stronger, helped them during the pandemic, the banking system, at least during the pandemic, the globally systemically important banks in particular, to remain stable and to deal with the huge shock that they face. So I think it will also be important for firms and businesses to do this. And I fully agree with what you said. The key will be to take the moral hazard of expecting to be supported with liquidity or other means, and incentivize them to actually take action to make themselves more resilient to this very shock-prone world that we live in.
Jayla, I think we have had really a wonderful tour d'horizon about an important set of topics. So thank you so much for joining us today. It was really a great pleasure to discuss with you, and I sincerely hope that next time you come to Brussels, or as I will move to Berlin, that we can have a chance to discuss further in some different format and perhaps in person. Thank you so much.
Thank you. And you are taking a very important role, and I look forward to coordinating in that role, especially given what we just talked about. And our dear colleague Jeremy is coming to take over your position. He is brilliant. So very happy for Bruegel. Big loss, huge loss for us. But I'm sure we will continue our great collaboration. Thank you so much.
Thank you so much, and it's really great to get Jeromin over here to Brussels. All the best. Bye bye.
Bye bye. Thank you.